All right, good afternoon, everyone. So today, and really for the next week or two, we're going to be going more and more into time value and basically just doing way more complicated examples of them. Before we get started, though, a couple quick announcements. I think I mentioned the investment basics thing. The Economics Club is hosting a debate watch party on September 10th. So if you're interested in attending, there's a flyer here. If you can just fill out the form, it just helps them know how much food and drinks to order for it. The first Ignite event is taking place after class. Yeah. So if you're interested in attending, it's SunTrust Room, one floor up, south side of the building. LinkedIn is a pretty common way for people to basically help network. And lastly, another research survey. If you have a few minutes to take the survey, I believe this is for SNAP benefits. So if you're interested, go ahead and fill that out. All right, so we're going to start today basically refreshing some of the stuff we were talking about last class because it's important, it's worth repeating. You're going to be using it throughout the rest of this semester, and if you're working in the field in any way, you're going to be using it in your job as well. It's very important that you're comfortable with time value. All right, so what is time value of money, or time value? Relative purchasing power of an asset across time. Right? Time is really what differentiates finance from a lot of other fields because we have to understand things across time. So whenever we're trying to value an asset, for instance, we need to understand when exactly the cash flows for that asset take place in order to figure out how much it's going to be worth today. Right, so the two ways that we can look at this, we have appreciable assets like stocks. We saw some examples last time on just how much growth we can see in the value of a single stock. In general, appreciable assets like stocks and bonds, real estate, they tend to appreciate and grow in value across time. And then we have things like just dollars, currency, right? That tends to deflate in value over time because inflation erodes its purchasing power. Right, so appreciable assets tend to increase your purchasing power across time. Then you have your deflationary assets like currency that tend to decrease across time. Very important to keep that in mind. Right, there is a non-trivial subset of people who think that putting your assets anywhere other than under your mattress is a bad source of investment. The opportunity cost of that mindset is gargantuan. Right, literally worth millions of dollars, of course, the time of your life, over the course of your career. Investing your savings over time is necessary to build wealth in the vast majority of cases. So, broadest definition we can apply to time value, the relative purchasing power of an asset across time. So a lot of this class is basically just figuring out timing and adjusting for that timing when we're looking at the value of the cash flow. So why do we need to make this adjustment? Right, the basic idea is $1 today is worth more in the future, and that's just the staple description of time value of money. And that's true, and we need to be able to adjust and accommodate for that fact. Right? One of the broad principles of time value is people prefer things now than they do later, and they need to be compensated for getting a cash flow later on. Right, so it's important that we keep this differential in mind. How exactly are we going to be adjusting? Again, we're going to be using discounting or compounding. In equilibrium, they're just mirror opposites of one another. When we're trying to find the present value of something, we're going to be discounting it. If we're trying to find the future value, we're going to be compounding it. Right, can anyone remind me the difference now between present and future value?
Present is how much you paid for it when you first bought it.
Or I guess a better way to phrase it would be how much it's worth to you when you buy it.
And then future is after a period of time, how much is it worth? So
yeah, very often retirement planning or large purchase planning in the future, something like that. Right, so these are the two ways that we're really going to be digging into time value. Present and future value. There are the two other components, the number of time periods and the rate. But again, there are going to be other methods for finding those rather than just applying the time value framework. All right, so present value, how much should we pay for something today? Future value, how much will it be worth in the future? Again, mirror opposites of one another. And this graph is a really good reflection of that. Right? So here we're taking the present value of $10,000 over this time period and the compounded value of $10,000 over the time period. So when we're looking at present value, the further into the future we're expecting to receive this $10,000, the less it is worth to us today. Right? If I tell you you're going to get a $10,000 bump in your salary, but that's not going to happen for 30 years, that's fairly worthless to you. All right, so the further out into the future we receive a cash flow, the less it's going to be worth to us today. Future value, again, is the mirror opposite of that. If we have $10,000 right now, we can invest it and compound that growth over time. All right, so when we're looking at present and future value, they're really just equal opposites. Right? It just depends what perspective in time we're evaluating the cash flow. Do we need to know what something is worth today, or do we need to know what something is going to be worth in the future? Again, looking at the formula for present value. So the present value is equal to our future cash flow divided by our discount factor. 1 plus the discount rate raised to the number of years. All right, so what's going to happen to the present value when we change our inputs? So what happens to present value? Does the present value increase or decrease as we increase future value? Yeah. Can you say that louder?
Increase.
Increase, yes. As our future value increases, our present value increases along with it. When our discount rate increases, what happens to our present value? Decreases. Right? This is basically, you can think about it as just pure math at this point, right? We increase the denominator and we're going to decrease the overall fraction, right? So economically though, when we're thinking about the discount rate, the higher the discount rate, the more we are discounting between years, right? So as a proportional fraction, the less valuable a cash flow is, the further into the future we receive it. And the number of time periods between when we are expecting to receive that cash flow and today. So as n increases, what happens to present value? Yes. As n increases, what happens to the present value? Does the present value increase or decrease as the number of periods increases? Decreases. Decreases as well, yeah. So we have a positive relationship between present and future value and an inverse relationship between present value and the discount rate and the number of time periods. All right, so when we're looking at present value, the things that we're really considering, how much is something worth? That's really what it is all about. And it's applicable to very many scenarios. Is it worth getting a degree? Is it worth pursuing this career track? Is it worth making this investment? Right? It's not just financial assets that we'll be investing in, but it's a framework that can be applied to a lot of situations. If we have, actually I forgot to include it in our workbook. I did this in the MSF course, but I can add in some data to show you guys what is the actual value of a bachelor's degree. And that's basically just by applying the present value to it. So I'll try to remember to add that into the Excel workbook over the weekend, and we can do that next week. How much is something worth is a great way to approach decision making, because very often people make decisions that either they end up regretting or don't realize that they could have made a better one, that they're paying an opportunity cost that they didn't realize they're paying. How much is something worth is always an important question to consider. Should we make an investment or not, right? That's that next step in the decision. We see how much something is worth. Is it actually worth pursuing with the cost in the end? And also, if you're comparing options, which is going to be the best option to take? All right, so we're going to pop over into Excel. Any questions before we start working on our examples here? All right, so last class we were going through both the formula and the function. Again, we're going to be repeating that. On the one hand, it's great because if we happen to make a mistake in one method, using the other method helps us basically sanity check ourselves. All right, so let's say that we're going to get $5,000 when you graduate in 2 years. Wouldn't that be nice if our grandparents did that? Hypothetically speaking, what's that going to be worth to us today if we have a 9% discount rate? All right, so let's use the formula. So we're just going to follow along exactly what the formula is telling us here. We're going to take our $5,000 future value
divided by 1 plus our discount rate raised to the number of years.
And I just learned this last night. My wife told me that's spelled C-A-R-E-T. Did anyone know that? I always thought it was spelled carrot, like the vegetable. C-A-R-E-T. A little bit of information there for you to take with you today. All right, so the present value would be $4,200. Now using the time value function, can anyone remind me how to recall the present value function?
Equals PV with the parentheses?
Yes. Yeah. All right, so once you start typing in actually anything, like let's just put in a T, let's see what it tells us. Checks whether a value is text. All right, so as you start typing in letters after an equal sign, there are very many functions that are included with Excel that you can kind of play around with. We're specifically looking for PV. All right, so once we type in the letters, Excel will tell us what function we're dealing with, open parenthesis, and it's going to tell you what inputs it needs to execute this function. All right, so we need our rate, our number of periods, and our cash flow. Either a single cash flow through a future value or a reoccurring cash flow stream with a payment. So we have our rate, our number of periods, and our cash flow. Remember, we're skipping payment for now because we're dealing with a single $5,000. And there's one additional step I have to make here when I'm referencing this $5,000. What is that?
Negative.
Negative. Yeah. If I don't put the negative sign here, Excel's going to give us the negative value. All right. So now we have the $42. Any questions on present value?
Can you do that one more time, how you got that answer?
The function?
Yes.
Yes. Yeah, so equals, or whenever we're doing any calculation in Excel, we have to have either an equal sign or a plus sign. Either one will get you doing a calculation, but I think it's easiest just to remember the equal sign starts any function that you're dealing with, or any calculation really. So we're starting our calculation. Equal sign tells Excel we're making a calculation. We're not just holding information. We've got our function defined here, present value. I know it's hard to see back there. It's saying PV, giving us the definition of what the PV is. Now we're getting our inputs for present value. So we're getting our rate, which is the 9% discount rate here, the number of periods, 2 years until we receive the cash flow, and then the $5,000 in 2 years. Keep in mind we're skipping the payment, which is the next option, so we're going to put in an additional comma here, or you can put in 0, either way, it'll get you the same answer, and a negative sign on the $5,000. Because this is our future value, and with time value money functions, we need to explicitly state what our cash outflow and inflow is going to be. That's what the negative sign is supposed to represent. Yes, when we're using a time value money function, we need a negative sign on the cash inflow or cash outflow. That's the reasoning behind needing the negative sign with time value functions. Any other questions? Yes.
How do you get to that Excel sheet? I've been trying to.
Oh.
I found it the first class and I can't find it again.
Sure. So on D2L, go to Content, Excel Practice, and this is the workbook as I'm completing and saving it in class.
Thank you.
Yep. Anything else? All right. All right, so now we're going to consider two different investments. Let's say each one costs $850 today, and we have a 10% discount rate. So investment A is $100,000 that we'll receive in 50 years. Investment B is $50,000 we'll receive in 47 years. So which of these two investments is going to be worth more? And are either or both of them worth purchasing given that it'll cost $850 today? All right, so let's go ahead and work through this. So I don't have the formula up here. Can anyone remind me, using the formula, how we're going to calculate the present value of this $100,000? Yes.
Do future value divided by 1 plus the rate.
Okay. So I'm going to be pedantic here. Is there anything else that we need to do? Yes. So we got 1 plus the rate. Okay.
And then to the 50th power.
before or after I would close the parentheses?
Parentheses.
Yes. Yeah, there you go. Very important that we correctly put the parentheses where they need to go because Excel is going to do exactly what you tell it to do. It doesn't know what you're thinking. It doesn't know what you're trying to do. It's going to do what you're telling it to do. All right, so we need to be very careful in how we just allocate our information. All right, and so we got the present value of $851.86. So if the purchase price is $850, would this investment be worth it? If we're following the criteria explicitly, if the value is greater than the cost, it's worthwhile. Right? So yes, you're right that the dollar difference is very much within the margin of error of whether or not this is going to be a positive return on investment. Right? Discount rates are, for the most part, just complete estimates. We don't know with explicit, with a guarantee what the discount rate is. But in a situation like this, where if we're guaranteed the return on investment, then yes, this would be worthwhile. Its value is greater than the cost, so it's worthwhile, at least economically. All right, so let's also use the function, right? We can always just double check our work by using these same, or these different methods to find the same results. All right, so we're going to use our discount rates, the number of periods, skipping the payment, and future value. So everything went well. Now we're going to calculate the value, the present value of investment option B, right? Nominally, it's worth half as much, but we're receiving it 7 years earlier. So is that 7-year time difference going to be worth double the value? Right? Because keep in mind, the timing of cash flows matter almost as much as the cash flows themselves. So let's use the formula, 50,000 divided by 1 plus our discount rate raised to here, $830. And we can replicate with the function as well. All right, so investment option B, is this worth purchasing? No, right? The value or the benefit is less than the cost, right? So in other words, no, it's not worth taking. Which makes the second question easier. Which option should we take, investment A or B? A, yeah. So it's the only one of these two options that's going to be, that's going to give us a positive result, positive economic value.
What was the formula you used for that one?
Which one?
The investment A and B value.
So I was using the both the present value formula and the function. So this is the formula that I used in the first calculations.
Is that the same formula we're using for this whole section of the homework?
It depends on the question that you're being asked, but this is the basic time value formula. All right, so all right, so if we rearrange this a little bit. This is why I have PowerPoints instead of writing on the board. All right, so either way you want to memorize this formula, this just is what we're going to be using for much of this class. Rearranging this formula is how we get to present or future value. Right? And what this is telling us is that any value in the future is worth whatever we have today times 1 plus our compounding rate and the number of years between our future cash flow and our current cash flow. Present value is telling us the exact opposite. We have some future cash outflow, in this case $100,000 or $50,000, that are occurring in either 50 or 43 years, each of them with a 10% discount rate. Right? And we're just rearranging this formula when we're jumping between present values or future values. So we're going to be using this a lot. Definitely important that you're comfortable with it, and I highly recommend going through practice examples after class just to make sure that you're comfortable applying these. And also, by the time we're done with class today, you're in a good part
good step to start your homework. Maybe take like one shot at it and then wait another week. Because by the end of next week, you'll probably be in a much better position to answer the first rounds of homework. I don't remember if I mentioned, I think I said it in an email or something. You get 3 attempts on your homework. The highest one is the only one graded, so I recommend using all 3 attempts to basically practice the material. It's all coming from the same question pool. That'll just help you get prepared for quiz and eventually exams. Any other questions?
You may have gone over this, but how do we check our work to see if, like, so you said we have multiple attempts on it. Is that like we turn it in and then you grade it and let us know how we did, or how do we?
So it'll tell you if it's right or wrong. It's not going to tell you the correct answer. So you'll basically just have to play around with figuring out what the correct answer would be in that situation. But there are practice sheets available on D2L that you can kind of work with and then check your answers as you're going through with the answers that are posted up. And if you're ever unsure, you can ask in class, post to the discussion boards. I'll respond as quick as I can. Anything else? All right, so let's say that we have $20,000 to invest, and we're going to invest in an S&P 500 ETF, which earns an annual average rate of return of 10%. So interesting thing with asset markets, depending on the time period and how we define the portfolio that we're looking at, stock returns on average earn between 8 to 12% per year, right? So this is basically a blind average of those values. So how much are we expected to save up over the course of time, right? Going from 40 to 50 to 55 years. All right. So a single $20,000 investment earning an average rate of return of 10%. All right. So again, following along with the formula, we're going to get the 20,000, dealing with future value now, times 1 plus our compounding rate, raised to the number of years. So a single $20,000 investment, earning an average rate of 10% over 40 years, will be worth around $900,000 after 40 years. All right, again, we're going to check this with the function. Who wants to walk me through the future value function?
Equals FV, parentheses, B113,
Great.
comma, B114,
The number of periods.
then skip the next one, and then negative B111,
Yes.
close parentheses.
Right, we're getting the same answer. So, especially early on in this class, I recommend using both the formula and the function, just in itself practice, as well as just double checking that your work is correct. Right? You should arrive at the same answer no matter the method that you're using to get that answer. All right, so if we have $20,000 invested over 40 years, earning an average of 10%, it's going to go to about $900,000. All right, now let's say we're saving up the same money, same average return, but we're waiting an additional 10 years. We're saving up for an additional 10 years. How much is that going to be worth? So we have our $20,000 times 1 plus our compounding rate raised to the 50-year investment period. All right, so that additional 10 years, now it's growing our portfolio value to $2.3 million. Again, we're not saving up more money. We're not earning a higher return. We're just waiting and investing for an additional 10 years. Again, double checking our work, make sure that's not an error. We use the future value, number of periods, and how much we saved up. Right? Again, checking out, working out, $2.3 million. Given enough time and a high enough rate of return, we can make any present value equivalent to any future value. Right? Across time, money compounds exponentially, so you can literally take $1 and grow it to $1 billion if you have enough time.
All right, and in the last example here, I'm just going to take a shortcut and cheat. So a nice thing in Excel is if you have the input basically equivalently structured, right? We can change what we're dealing with here, but if we have it equivalently structured, we can just copy and paste our formulas and functions over, and they'll automatically update with the information that it's referencing. All right, so all I did here, Control-C, Control-V, copied over our formula and our function, but now we're looking at a 55-year compounding time frame. So we went from 2.3 million to just under 3.8 million. All right, an additional $1.5 million from an additional 5 years saving and investing.
Can you show how you copied and pasted the funds again?
Yep, so all I did was highlight these two cells. So when you see me highlighting these cells, I'm holding down the Shift key and using the arrows to kind of move around the workbook here, right? See how I'm highlighting different areas? I'm holding down Shift and using the arrow key to highlight those areas. So I want to copy and paste over the formula and function from cell E118 to F118. So I'm hitting Control-C, and you'll see the workbook, it'll get those lines now that around the area that you're copying. And then I'm going to highlight the area I want to paste it into, again, holding down the Shift arrow key and Control-V to paste it over. Control-C, Control-V, just make sure it's in the area you want it to be in and that the references are the same. All right, so for example, let's say I'll copy and paste this into an incorrect area. What's going on is Excel is just relative referenced, right? Meaning when I'm copying over this function, its references are based on its relation to the cell physically, right? So I'm copying the cells that are in the same column, but 3, 4, and 6 rows higher. So that's exactly what's going on down here. I'm referencing values in the same column, 3, 4, 6 cells higher, right? But those cells don't contain information that it can make this calculation from. So copy and paste, you have to make sure that your inputs have the same relative reference wherever you're copying and pasting to. Any other questions? Yes.
Okay, this is somewhat off topic.
Okay.
With investments, it's like you buy like a share or stock, and do we just like keep that for like that 50 years, like we don't touch it?
Yeah.
So it would be like trading where you sell and buy kind of thing. You just leave it alone.
So what I'm referring to here is basically just buy and hold. On average, people are very bad at trading, and they tend to lose money over time when they trade. Well, they don't perform as well on average when they actively manage their money relative to passively manage. We'll probably have some time to actually look at the average values of different portfolio management methods, but net of fees, actively managed funds tend to underperform the overall market. So this is just based on an average return to a buy and hold strategy.
So like when we go like to become like when you're a financial advisor and your client comes to you like to build up their portfolio, you tell them, oh, buy the share and just leave it.
Yes. Yeah. So I'm not a financial advisor. This isn't financial advice. But as an expert in the field, the best long run strategy is typically just buying and holding a low cost passive ETF. The vast majority of my investments are just that. I do have some actively managed funds that I do just because of my research and things that I like to work on, but that's because I'm technically a subject matter expert and I like to just play around with the field. But for the most part, buying and holding is the best investment strategy over the long run. The boring stuff works with this field. Unfortunately, the worst things that we see, like the 2008 financial crisis, are usually the result of people getting a little too risky and having a little too much fun with their investment decisions.
Yeah. What do you think is the best minimum time to hold a share? Like at least 20 years or something?
So I can't say that there's a best minimum time, because in general, the longer you can hold on to it, the better, the more it's going to grow by, right? So for example, when we're looking at this example that we just did here, we're dealing with a 15-year difference Nothing's changed with the investment. Nothing's changed with the average rate of return. But we're going from under $1 million to just under $4 million just from our holding period. And when we look at exponential growth over time, the more time we allow a portfolio to grow, every additional year it's going to continue exponentially growing on the latter years. All right, I think that's something that we saw. Let me pull up the slide real quick. Yeah, there we go. All right, so when we're dealing with exponential growth, every year that we can postpone, on average, we're going to see more and more growth occurring. So there's nothing I can say that there's a minimum time period, but the basic idea is the longer you can allow a portfolio to grow, the more it's going to exponentially achieve that. But good questions, not off topic, actually quite on topic. I think I mentioned the first class. I'm working on getting certified as a certified financial planner. So I will be legally qualified to give it financial advice, but at this point I'm not. I'm just talking about what research shows over the long run.
This class is recorded.
Yes.
I just didn't find it.
So on D2L, go to class recordings, under content, class recordings, NAPTO recordings. And here they are. Yep. Any other questions?
Actually, yes, I have a question.
Mhm.
So in this worksheet,
Mhm.
and you may have said this already, I might have missed it, what's the purpose of doing both the formula and the function if we're getting the same answer both ways? And it's the same thing we're typing in both times?
Sure. So two things. One, later on in this class, we're going to see that there are times when one or the other is going to be easier to use.
Okay.
So we need to be able to do both of them.
So right now we're just getting comfortable with it.
Yes.
essentially. Okay.
But also right now, as you're getting comfortable with it, this is also just to double check that your work is correct, because you should arrive at the same result using either method.
So if you're getting the wrong answer, that's how you know you did something wrong.
Yes. Yeah. You should be able to use both of these and arrive at the same exact answer. Anything else?
So on exams and homework and stuff, are we going to be using, this is just like a tool we're using, right?
Correct.
You're saying we can like just use it like on a calculator or just whatever?
Yeah. Whatever you want to use as your calculator, you can. If you prefer a financial calculator, scientific calculator, you're welcome to do that. I like to use Excel because this is what people tend to use in practice.
Okay, I just didn't know if the exams would be like on Excel or something.
No.
I didn't know the format.
No. This is, you can use whatever tools you want to calculate the answers. You can use Python if you prefer that. But we're using Excel just because so many people use it.
Did you say that on the exams that we won't have Excel, we'll have to use a calculator? Or
So no. So like professional exams, you're required to use a calculator. So like the CFA, CFP, CPA, those sorts of qualification exams, you're required to use a calculator.
we'll use Excel.
Technically, you can use whatever you want. I'm choosing to use Excel just
Okay.
as our calculator. Yeah, but you can use whatever method you feel like. Mm-hmm. Actually, I think I was supposed to hop back over to the PowerPoint at this point. I should have little notes in here to remind me when I'm supposed to go to the other one. All right, so we're going to talk about the details on what I'm about to do. We're going to talk about the details more next week, but I just want to give an example here on the difference between saving $20,000 once and saving $20,000 annually. All right, and we're going to see a significant jump in the value of these portfolios here. All right, so now we're going to be saving up $20,000 per year over these time periods, earning an average return of 10%. So we're going to go ahead and use the future value function. We're going to get the rate, number of periods. This time we're not skipping the payment because the payment is reoccurring cash flows over a time period. When we're using the future value functions and formulas, the payment is a reoccurring cash flow. The present or future value is a single cash outflow. All right, so this is one of the situations where using the function is much easier than using the formula. All right, when I show you the what's called annuity formula next week, you're going to really appreciate this function. It simplifies a lot of messy calculations. All right, so again, we're saving up $20,000 per year instead of once. All right, so saving up $20,000 per year, earning an average rate of return of 10% over 40 years would compound to $8.8 million. And this is part of the reason why there are so many millionaires in the United States per capita is it's not because everyone's coming up with brilliant individual ideas, it's because they're passively and slowly investing in asset portfolios over the course of their career. All right, and the more you're able to save up, the longer you're able to save and invest in appreciable assets, the higher your portfolio value is going to be. All right, so let's see what an additional 10 years of savings is going to do to this, right? We more than doubled our value over those additional 5 years. And again, we see a significant jump in the value of this portfolio. Right? Going from 8.8 million to 23 million dollars, just saving up an additional 10 years. And if we were to save up an additional 5 years, again, another significant jump in value. We're going from 23 to roughly $37.5 million. So what is hypothetical is the average rate of return over this time period, but these are the sorts of rates of returns. This is a rough average that the market earns over a long time period. $20,000 is a lot to save up in a given year, all right? And we're going to play around with different examples of different rates of savings over the course of a career time span. But it is possible to save up and generate millions of dollars in your portfolio if you just save and invest in appreciable assets over the course of your career. Yes?
What was that formula again?
Yep. So I'm using the future value function. All right, so it's equal sign FV. That's calling the future value function. And then open parenthesis, and then the inputs that it needs, the rate, the time period, and the cash flow.
I put that same formula in, but I'm still getting the answers from the line above, the highlighted areas.
So are you putting 2 commas in?
Yes.
So that's the difference here between the previous example and what we're doing now is I didn't skip the payment section.
Okay.
Any more questions? Yes.
Why did you skip the payment section?
Why did I what?
Why did you skip the payment?
Because the payment is a reflection of reoccurring cash flows, which is what is happening in this example now, right? So we went from saving up $20,000 a single time to saving $20,000 every year. So what we're doing with this future value function now is the payment reflects reoccurring cash flows every single year. So this is $20,000 in year 1, $20,000 year 2, so on every year for 40 years. So that's what the payment part of the time value function is reoccurring cash flows. The reason we were skipping that before is because it was just a single occurrence of $20,000, a single savings. Any other questions?
You still only have to put a negative on one of the
Cash flows. Yeah.
So you have to put it on the payment.
So this is still a cash flow, so I do have a negative sign here, yes. Yeah. You always need a negative sign on either the cash inflows or the cash outflows, right? So if I take that negative sign out, you're getting that negative value. Yeah, so there's still a negative sign in there. Anything else? All right, so like I already said, future value is the mere opposite of present value. With future value, we're concerned with what a cash flow that we have already made or will be reoccurring and what that's going to be worth in the future. Right? And again, all the present future value, mere opposites to one another. They're derived from the same formula, just moving around our discount factor here. Let's think now what happens to the future value as we change its inputs. We're not dealing with a fraction now, so a little bit easier and cleaner to see what the relationship is. As we increase our present value, what happens to the future value? It goes up. Yeah, the more money we save up, the more money we will have earned and compounded over time. If our rate of return goes up, what happens to our future value?
goes up. And if we save for a longer time period, what happens to our future value? It goes up. Yeah. So all of the inputs to future value are positively related to it. As we increase our savings, we increase our future portfolio value. As we increase our rate of return, we increase our portfolio value. As we increase the amount of time that we save for, we increase our portfolio value. And a really interesting thing that we'll be able to look at next week is we'll see the effect of small differences in the rates of return and how that can compound into significant amounts of money over time. And that's part of the reason why the low-cost index ETFs that have become so prevalent in basically just saving for retirement, long-run savings, why they've become so popular is they've saved, I don't remember the value, but it's billions of dollars to typical retail investors. And only because they're saving us fractions of a percent in costs per year. But that fractions of a percent really compound exponentially over long time periods. All right, so what are we using future value for? The main idea is retirement planning on saving for future benefits that we might be interested in, right? It could be helping our kids out with college, helping grandkids out. If there's a really important project that we want to invest in, figuring out how much we need to save to make that happen. It helps us with asset allocation, right? If we can look at the average rate of return of different asset classes, what is the asset class we should be investing in? We'll also do some examples with that later on. And which investment route should we take? Right? And again, similar to present value, ignoring time value ignores absolutely important and relevant information for any sort of planning and decision making that we're going to be engaging in, both for our personal financial lives and in the course of your career. Let me see if I missed doing an example over here. All right, we'll get to that in a minute. Oh, yeah. So one point I forgot to make with kind of the example that I was looking at here. Right, a lot of people have a fixed day in mind for when they want to retire, right? And for example, I have family members that have a fixed date in mind. They want to retire when they're 60 years old. That's in spite of the fact that they don't have a portfolio that they could comfortably retire on at that point, right? So if you extend retirement by 5 to 10 years, it's not just a little bit more money that you're saving up. It's potentially millions of dollars at that point that you're going to be saving up in additional value over those 5 to 10 years. And that can be a really beneficial decision for you to make, right? You're all young and just starting your career off. Why do you want to think about retirement already? Well, because the best time to think about it is before you ever need it, right? It's one of those situations. So if you can make good decisions early on in your life, the more it's going to benefit you exponentially so later on in your life. Right, so present and future value, those are the main things that we're going to be focusing on in time value. We will be using that throughout the rest of this course. Right? I'm telling you this now because you need to really understand it. You are going to be using it in class, hopefully for your own financial planning purposes and making good decisions for yourself financially. But there are technically the other components in time value that we can evaluate as well, right? The rate and the number of periods. But again, the number of periods is usually assumed or known ahead of time. When we're dealing with something like the bond market, a bond issue tells you the time to maturity. So you know and ahead of time. There's no estimating it. When you're dealing with something like valuing a public stock, there are standard practices that people use for evaluating its portfolio value, typically with using a terminal value approach in 5 to 10 years. Right? So N is usually known or assumed, and the discount rate is going to be estimated basically just using a different time value framework that we're going to talk about at the end of the semester. Right? So N and R are usually known or estimated in a different way, and our focus is going to be on present and future value. Right? Again, all that being said, we can technically calculate these by, again, rearranging and solving for, in this case, N. Right? So if we want to get that out of the denominator, we'd have to take the natural log of this value, which being an equal sign, we have to take the natural log over here. So we would just do a little bit of arranging to arrive at calculating for N.
So we'll do some quick examples for this. All right, so how long is it going to take to grow $100,000 to $1 million at different rates of return? All right, so as our rate of return increases, do you think it's going to take less or more time to make this savings goal? Less. Yeah. The higher our interest rate, the less time we need to make a goal. Difficult thing is, with asset classes that are readily available to retail investors, the average rate of return is usually going to be somewhere between technically negative 2% if you're holding on to just pure cash and looking at the real value of it, up to about an average return of 14 to 16% with the riskier public equities. Right, so that's a little bit above the average rate of return that's readily available to us, but it just helps make this example a little nicer. All right, so we want to figure out how long it's going to take us to grow rather than dealing with that messy formula. Can anyone remind me what's the function that we're going to be using here?
NPER.
Yes. NPER. Looks like I hit caps lock at some point. All right, again, roughly the same input information. All right, we need the rate. We have a single cash outflow, so again, we're skipping the payment. But now it's asking us for a present value and a future value. All right, and so this is where things might get a little funky, and I'm going to make a intentional mistake here just to show you. Right. I'm getting an error. Why am I getting this error?
No negative.
No negative sign, yeah. Now, I can put the negative sign anywhere I want, and it's going to get us the correct answer. Right? I could put it on the present value, or I could put it on the future value.
Strictly speaking, when we're looking at this cash outflow, the savings is our cash outflow. Right? So economically, it makes a little more sense to put the negative sign on our present value because this reflects us saving money coming out of our bank account, going to an investment portfolio. So that's what we're going to use. All right, so if we can get a rate of return of 4.5%, it's going to take us 52 years to grow our $100,000 into $1 million. What if we get an average rate of return of 9%? Copy and paste this over again, hitting Control-C on this cell, Control-V into the cell I want it. All right, so if we roughly double our rate of return, we roughly have the amount of time we need in order to increase our $100,000 into $1 million. And again, doubling our rate of return, we again roughly have the amount of time that we need in order to increase our $100,000 to $1 million, to 14 years. Still a sizable amount of time, but certainly within a career time frame.
Is that an in after the equal sign that you put, like equals in the formula?
NPER. Yes. NPER, number periods.
Oh, yes. Okay.
Yeah. Any other questions on number of periods?
You may have said this, I'm sorry. Do we need to put a negative in front of either the present value or the future value?
Yes.
Does it matter which one?
Technically, no.
Okay.
You can put it on either, but the important thing is that it is consistent, right? Where it would matter a lot more is if we have a payment. Then that's going to throw us off a little bit. But
whenever we do the payment, is it one or the other specifically, or is
it depends on the scenario,
scenario?
right? So if in this case we're saving up $100,000 per year, then we should put the negative sign on either the payment and present value. The payment would line up with the present value, or just on the future value. Any other questions? And our discount or growth rate, again, we can calculate it from our time value framework. Again, we'd have to take natural log to get the exponent out of here, and we can solve for getting R by itself.
But we can skip that mess and just use the rate function. All right, so if we have $7,500 and need $10,000 in 3 years, what rate of return would we need to make this happen? All right, so we're going to use the rate function equals rate, open parenthesis. We get our number of periods. Again, we have a single cash outflow, so we're skipping our payment. We have our present value and our future value. All right, so it's telling us that if we need to grow our $7,500 into $10,000 within 3 years, we need an average rate of return of about 10%. All right. So as the number of years increases, are we going to need a higher or lower rate to meet our goal? Lower. Yeah, exactly. Now, if I copy and paste this formula that I have here on over, like I did in the above examples, we're going to get an error. Why are we getting this error?
Because you didn't change the n.
Because what?
You didn't change the 3 in the equation, and it's a different thing on
The inputs, yeah. So basically, our relative reference now, as I copied and pasted this formula over, is still relative to the cell, and we don't have the information in the cells that we copied into. So our references aren't there. All right, so what we can do to fix this is use what's called a fixed referencing now. Actually, we're going to have to add some information here because I forgot to leave the years in its own cell. But what we're going to do is allow the number of years to vary. But we're going to fix our reference to the present, the present value and the future value. All right, so what I'm doing here is I'm highlighting the value I want to fix the reference to and hitting F4 on Windows. I don't remember what the shortcut is for Mac, but you can also manually put in a $ in front of the column reference and in front of the row reference. And that's going to fix your cell reference. And what's going to happen now is when I copy and paste this over, I need to put in our 612. Right, this is just because of the referencing things. The relative reference was for our number of years was 1 column over and 3 rows up. So that's why I put the 6 and the 12 floating out here. But our reference to the original present and future value stayed locked. Right, so fixing our cell references can help us when we're just wanting to change one input at a time. And we can still reference our original information. All right, so we're updating our number of years to 6 and 12 years respectively, and that is reducing the rate of return we would need as we should expect.
Can you do that formula one more time?
Yes. So I'll completely redo this with the cell references. We're using the rate function, and we're going to hit the number of years, no payment. We're referencing the $7,500, and I'm going to fix this reference by hitting F4. Or again, you can manually put in the $ in front of the column and row, and then referencing the future value. Again, hitting F4, locking in our reference to that cell. All right, so now when we copy and paste this function over, it's keeping our references to these initial present values locked in. Right, so it's not using Excel's default relative reference. Again, I can't remember what the Excel shortcut is. I had a reference sheet for Mac at some point, and I think I lost it. So I gotta find another good reference for that. But yeah, unfortunately, Mac and Windows have different keybinds, so it's gonna work a little differently if you're using a Mac. F4 is still the same for Mac?
I don't think so.
Okay.
I did the same thing. I didn't get that answer.
Okay. If you're having problems replicating this, I can take a look at your workbook after class. If anyone else is having issues too, I can look at your workbook after class. Yes?
The shortcut is Command T.
Command T for Mac? Okay. Well, there you go. Command T to fix reference in a Mac. Any other questions?
All right, so what determines this discount rate that we're looking at? Really, it's going to be a lot of things, but the basic idea for the model that we're going to use at the end of the course is based around the opportunity cost of something. Right? So if you remember opportunity cost from your economics courses, the basic idea is it's the next best thing. So we can think of the discount rate as, in essence, a hurdle rate, or the minimum rate of return that has to be earned on an asset for it to be worth investing in. The rule of 72, this was used very frequently in the past when computers were not readily available. So this isn't as valuable to us nowadays, but it's still something that's generally expected in this course. So what the rule of 72 does is it takes literally just the number 72, you divide it by the interest rate, and that gives you a rough estimate for how long it's going to take to double your investment. All right, so quick example with that. So let's say we have a 7.5% interest rate divided by 7.5 equals 9.6. All right, so let's give this a test run. If we want to double our investment, let's say we're starting off with $100 and we want $200. What is the future value of our $100 for 9.6 years? Oh, wait, nope. Mess that up. Future value, we got to start with the rate. 7.5%, 9.6 years, $100. Is this going to be equal to $200? No. Oh, I put in the payment. Yeah. There we go. So at 7.5% rate of return, it would take almost a decade for us to double our money. We can confirm that just applying it with our future value function here. All right, so Rule 72 can just be a really quick way to get a guesstimate of how long it's going to take to double your money at a given rate of interest.
Can you do it one more time?
Yep. All right, so Rule 72, we take literally just the value 72 and divide it by the percentage, divide it by the percentage of our interest rate, 7.5. It's telling us that it'll take about 9.6 years to double our money. So if we have $100 and we want to double that, we can use the formula this time. 1 plus 7.5% raised to 9.6 years. And we've now roughly doubled our $100 to $200. So it's basically just double checking that this answer is getting us a relatively close estimate.
What was it that you multiplied by? Was that just not 9.6?
Where?
In your formula.
Right here?
Yes.
Oh, so it's not multiplication, it's an exponent.
Okay.
Yeah, that's a caret, a C-A-R-E-T. Any other questions? And again, I'll post this online after class. If you have any questions with your Excel sheet, we can talk about that. Right, so the general association, whenever you're considering how an input's going to affect the output, you can always just look at the time value formula that we're dealing with. Right, so if we're looking at the present value, a future value we know is going to increase it, and a higher discount rate, a higher number of time periods, a longer time until we receive that future cash flow is going to reduce our present value. Future value is a bit simpler. Every single thing is positively related to our future value. Right? We increase our savings, we increase our rate of return, we increase the amount of times that we save for. That's going to increase how much we're going to be able to compound over our savings time frame. All right, so at this point, I highly recommend you take a shot at your first homework, maybe just one attempt at this point, see what you're struggling with. Next week, we're going to be going, again, more time value money stuff. We're going to be dealing a lot more with multiple cash flow streams, which are much more typical for us to be working with. Hope you all have a good weekend.
Let me just get this Excel sheet posted before I move it. Take care.